Most people know there is a $10,000 rule at banks. You deposit more than $10,000 in cash and the bank reports it to the government. You knew that already. Here is what you probably did not know. Depositing $9,500 in cash is also potentially a federal crime. Depositing $9,500 twice in the same week is more likely to get your account seized than depositing $20,000 once. And the government can take every dollar in your bank account based on the pattern of your deposits alone, without charging you with any crime, without proving the money came from anything illegal, and in many documented cases, without ever giving it back. The $10,000 rule is not the dangerous part. The law built around it is. Here is what most people understand about the $10,000 rule. Banks are required to report large cash transactions to the government. This is to catch drug dealers and money launderers. If you are depositing legally earned money, you have nothing to worry about. Stay under $10,000 and you are fine. That is the conventional understanding, and it is dangerously incomplete. It describes one part of the law. It leaves out the part that has cost ordinary American citizens tens of millions of dollars in seized assets, most of which were never returned. Life good. Here is the rest of it. The Bank Secrecy Act of 1970 requires banks to file a currency transaction report with the Financial Crimes Enforcement Network, called FinCEN, for any cash deposit or withdrawal of $10,000 or more. You are not told when this report is filed. You cannot opt out. The report includes your name, address, social security number, and transaction details. That is the part most people know. What most people do not know is that a separate law, 31 U.S.C. 5324, makes it a federal crime to structure your cash transactions specifically to avoid triggering the $10,000 reporting requirement. This crime is called structuring, and it applies even if every dollar you are depositing was earned legally, reported on your taxes, and came from a completely legitimate source. Here is exactly how people end up on the wrong side of this law without knowing they crossed it. Here is how the structuring law works and why it catches people who have done nothing wrong. A small business owner runs a restaurant. She takes in cash every day. She deposits it at her bank several times a week in amounts ranging from $5,000 to $9,000. She does this not to avoid any reporting requirement, but because that is how much cash she takes in on any given day. She has been doing this for years. She has never been charged with any crime. She pays her taxes. Her accountant handles her books. One day, her bank account is seized by the IRS Civil Asset Forfeiture Division. The IRS noticed a pattern of deposits consistently below $10,000 and filed a structuring complaint. Under civil asset forfeiture law, the government does not need to prove she committed a crime to seize her account. They need only demonstrate probable cause that the money was connected to a structuring violation. The pattern of deposits, cash amounts just under $10,000, repeated over time, is sufficient to establish probable cause. Her account is frozen. She cannot pay her suppliers. She cannot make payroll. To get the money back, she must prove the negative. She must prove she was not structuring. This requires hiring an attorney, filing a claim in federal court, and waiting months to years for a resolution. Legal fees routinely exceed $20,000 to $50,000 for a case that may ultimately result in the return of the original seized amount with no interest, no penalty against the government, and no compensation for legal costs. The escalation looks like this. A business owner deposits $8,000 on Monday, then $7,500 on Wednesday, then $9,200 on Friday. The IRS sees 3 deposits totaling $24,700, all under $10,000, all in the same week. The pattern triggers a structuring flag. A structuring flag triggers a civil asset forfeiture investigation. A civil asset forfeiture investigation freezes the account. A frozen account destroys the business before a single day in court. Here is the part that makes this genuinely extraordinary. Until 2019, the IRS did not need to believe the money was connected to any underlying crime. They did not need to believe it came from drug dealing, fraud, or tax evasion. They needed only to believe the person had structured deposits to avoid the reporting threshold. Structuring itself was the crime. The money was presumed dirty until proven clean, and the burden of proof was on the depositor, not the government. There are several specific legal mechanisms inside this system that each operate differently and each create a different kind of trap. Each one has a name. Currency transaction reports, filed automatically by banks for any cash transaction of $10,000 or more. The depositor is not informed. There is no opt-out. The report goes directly to FinCEN, a bureau of the U.S. Treasury Department which maintains a database of transaction reports. In 2022, banks filed approximately 17 million currency transaction reports. The vast majority involve no criminal activity. Suspicious activity reports. This is the reporting mechanism most people have never heard of. Banks are also required to file suspicious activity reports for any transaction they consider unusual, regardless of the dollar amount. There is no minimum threshold. A bank can file a suspicious activity report on a $200 cash deposit if the teller believes the behavior is unusual. The depositor is legally prohibited from being told a suspicious activity report has been filed on them. This prohibition is written into federal law. In 2022, banks filed approximately 3.6 million suspicious activity reports. You will never know if you are in that database. Structuring, the federal crime of breaking up cash transactions to avoid the currency transaction report threshold, defined under 31 U.S.C. 5324, punishable by up to 5 years in federal prison and civil asset forfeiture. Applies regardless of whether the underlying money is legitimate. The intent to avoid reporting is the crime, not the source of the funds. The critical word is intent. The government argues that a pattern of sub-threshold deposits demonstrates intent, even when the depositor claims the pattern was coincidental. Civil asset forfeiture, the legal mechanism by which the government seizes property connected to alleged criminal activity without a criminal conviction. In structuring cases, the government files a civil complaint against the money itself, not against the person. The case is titled something like United States versus $107,702 in US currency. The money is the defendant. The owner must intervene in the case to claim it back. The legal standard for forfeiture in federal civil cases is a preponderance of the evidence, meaning more likely than not, which is significantly lower than the beyond reasonable doubt standard required for criminal conviction. The 2019 IRS policy change. In 2017, the IRS announced it would stop pursuing structuring cases where the underlying money was from legal sources. In 2019, the Treasury Inspector General for Tax Administration confirmed that the IRS had largely ended the practice of seizing accounts for legal source structuring. The policy change came after significant pressure from Congress and the Institute for Justice following documented cases of legal source seizures. The change was a policy decision, not a law change. The law itself, 31 U.S.C. 5324, still makes legal source structuring a federal crime. A future administration could resume the practice without passing new legislation. What could possibly go wrong? Here is what this system looks like in documented real cases. The Institute for Justice, a non-profit law firm that litigates civil asset forfeiture cases, documented a series of IRS structuring seizures between 2012 and 2017 that became the factual basis for congressional hearings. In one documented case, Carol Hinders, an Iowa restaurant owner, had her entire bank account of $33,000 seized by the IRS for structuring. She had been making regular cash deposits for decades. Her business operated entirely with cash. She had never been charged with any crime. The IRS seized her account without warning. It took 2 years and significant legal costs before the money was returned. In another documented case, dairy farmers Jeff and Randy Sowers had $62,936 seized from their farm account. The IRS cited a pattern of cash deposits under $10,000. The Sowers family had been depositing milk sale proceeds in cash for years because their rural bank branch had a cash handling limit. They were not drug dealers. They were farmers. Their money was seized. The IRS eventually returned it after national media coverage, but only after the family had incurred significant legal fees. A 2017 report by the Treasury Inspector General for Tax Administration reviewed 278 IRS structuring seizures between 2012 and 2014 and found that in 91% of those cases, the funds were derived from legal sources. The government was seizing legally earned money from people who had been flagged for a pattern of cash deposits, not for any underlying criminal activity. The total amount seized in those 278 cases was approximately $43 million. The IRS returned approximately $15 million voluntarily. The rest required legal action to recover, and not all of it was returned. Yes, this is real. In 2014, the New York Times published an investigation titled "Law Lets IRS Seize Accounts on Suspicion, No Crime Required," documenting dozens of cases where small business owners had bank accounts seized by the IRS under the structuring law despite no evidence of criminal activity. The investigation by Charlotte Dewin identified cases involving a medical supply distributor, a restaurant owner, and a farm that had all had accounts seized based solely on patterns of cash deposits. Following the New York Times investigation and subsequent congressional attention, the IRS announced in October 2014 that it would change its policy and only pursue structuring cases where the funds were connected to other criminal activity. In 2017, the policy was formalized. In 2019, the Treasury Inspector General confirmed the change had largely taken hold. However, The Institute for Justice continued to document cases after the policy change, and critically, the law itself was never amended. 31 USC 5324 still makes structuring a federal crime regardless of the source of the funds. The protection against legal source structuring seizures exists only as a matter of prosecutorial discretion, not as a matter of law. If the policy changes, the seizures can resume the next business day. If you regularly handle cash, here is what the legal framework actually means in practice. 1. Never deliberately structure deposits to stay under $10,000. If you have $15,000 in cash to deposit, deposit $15,000. The currency transaction report will be filed. That is fine. It is a report, not an accusation. The report alone has no legal consequence. Deliberately splitting the deposit into 2 transactions to avoid the report is the crime. 2. If you regularly handle cash for legitimate business reasons, document why. Keep records that explain your deposit patterns. A restaurant that deposits daily cash receipts has a documented reason for regular sub-threshold deposits. Sales records, point-of-sale reports, and accountant records all establish that the pattern reflects business activity, not structuring intent. 3. Know the difference between a currency transaction report and a suspicious activity report. You will never be told about either. But understanding that both exist and that the suspicious activity report has no minimum threshold means understanding that any unusual cash behavior can trigger a report regardless of the amount. 4. If your account is frozen or seized, do not wait. The deadline to file a claim contesting a civil asset forfeiture in federal court is typically 35 days from the date of the seizure notice. Missing that deadline can result in a default judgment against you and permanent forfeiture of the funds. Contact an attorney immediately. 5. The 2019 IRS policy change is not a law. It is a prosecutorial policy that can be reversed without congressional action. If you regularly handle large amounts of cash, the legal risk from structuring has not been eliminated. It has been reduced for now. Operate accordingly. 6. Know your state's civil asset forfeiture protections. Several states, including New Mexico, North Carolina, and Nebraska, have significantly strengthened protections against civil asset forfeiture, requiring a criminal conviction before property can be permanently forfeited. Federal law still applies to federal cases, but state law applies to state-level seizures. Knowing your state's rules matters. This is not financial advice. Please do not sue us. If this reached someone who thought staying under $10,000 was safe, share it. The dangerous part of this law is the part nobody explains before you run into it. The channel grows when the right people find it at the right time.